G'day, welcome to the program. My name's Andy Semple and I'm from Share and Options Dealer Andika. Today I'd like to talk to you about writing put options. Now, what is writing a put option? It's selling a put means the seller is obligated to buy the underlying share at the strike price of the particular put option. For this obligation, the seller of the put option receives the options premium. Selling put options is similar to underwriting insurance. Let's have a look at an example here using this particular payoff diagram. In this example here, we've sold a particular put option at a strike price of $4, for which we receive 30 cents. Now, the most you can make from selling the put is the premium received. So in this case here, the profit would be 30 cents. However, if the underlying share should go down in value, then because we have an obligation to buy this particular stock, we're exposed to that as the stock were to fall. But we do have a little bit of downside protection. You can see here from the payoff diagram that anything below $3.70, then we're starting to lose on this particular trade. Now let's now jump to this particular table and actually look at an actual put example, this time on BHP. Now the stock price at the time was $40.03, and we've just sold here one December 2009 $38 put option contract, for which the market paid 50 cents in options premium. Now, you can just see on the bottom part of the particular table how it just goes through what the profit would be on that particular trade. And that assumes that this put option expires, worthless, of course. What you've got to be mindful about when you sell the put is, and we'll come back to this, is be mindful of the amount of contracts you're prepared to sell, because you've got yourself ACH margins to cover. Remember, you're selling puts, you're putting your hand up to the market and saying, I'm happy to buy this particular share at that price. So you've got to make sure you've obviously got the reserves to cover it. Another way of looking at selling puts, but if you want to mitigate the risk, would be to do a price spread with puts. And here's another payoff diagram here. Notice we've sold the same $4 put for which we received 30 cents. But notice we also bought the $3.50 put for which we paid 10 cents. So 30 cents in, 10 cents out means our profit there is 20. But you can see also we still have some downside, but it is capped out. The spread then is selling at $4, buying at $3.50. So the risk there is 50 cents. The net credit received is 20. So the maximum risk, if we do it as a put spread, is therefore 30 cents. Now this is not a bad thing to do, particularly if there's a little bit of volatility in the market, because at least then you've got a means to stop out of the position if it goes against you. Now here's some basic trading rules to be mindful about when selling put options. Now, selling in the money put options is an alternative to the buy right. Selling out of the money put options is effectively agreeing to buy the stock at, say, a wholesale price, just like that example we just showed you earlier on BHP. BHP at $40, selling a $38 put. That means you're prepared to buy the stock at that level at 38, even though at the time it's around 40. Now keep in mind that it'll only happen should the underlying share fall in value and the option be put to you. Now, in the money put options can be rolled to another expiry date and or strike price. Now this is important because sometimes you do sell put options and you may not want to take delivery of the underlying stock, so you want to roll over the option position. But just be mindful, if the put options that you have sold all of a sudden become very deep in the money, trying to roll them is really a pointless event. You're either best to close out and take the medicine or take the underlying stock. You should always really only sell put options if you're prepared to buy the stock. That's really important. So using that BHP example earlier, we sold just one contract because remember, you're obligated to buy 1,000 BHP shares at a strike price of $38. So that means you need to have the $38,000 there to pay to buy that stock. If on the other hand, you don't have that sort of collateral or that sort of cash there, then you would look at doing the spread that we showed you earlier. And if you wanted to do it as an example on BHP, that would be like selling the $38 put and maybe buying the $34 put underneath. At least you've quarantined what the risk can be. If you are going to do spreads, however, try not to leg them in. What I mean by that is don't try and go to the broker or do it online and say, first of all, I'll sell the $38 strike. Once that's filled, I'll now go and buy the 34. The reason there is the market might catch on to you and they'll, make the price a little bit more expensive, whereas you can go to your broker and you can do what we call a combination trade. saying, I want to sell the 38 put, buy the 34 put, and I'm after X credit. And then you can, alter that particular price to get set. And finally, be mindful of your margins, particularly the margins that are going to be charged from the Australian Clearinghouse. It's very, very important that you've got the collateral there to cover your obligations. If anything we learned about the recent GFC was when the market fell, you don't want to have a lot of put option contracts on your account. Now, if you've got the cash, fine, you can take them. But if you don't have the cash or the collateral, you can find yourself in a lot of strife very quickly. Well, that covers selling puts today. I look forward to catching you next time around. Good trading.